What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Charlie with you today, unpacking all the news of the week. Ben, how's your week been so far?
Yeah, it's been a good week so far. It's good to have you both back on the show this week.
Yeah, we've been ships in the night the last few weeks. We've had the new Broker Academy going around the country, so I've been travelling for that. And Charlie, you've been busy as well, and you were poorly, I think, last week too.
Yep.
So between the three of us, Ben has been the stalwart, spearheading the news and the What's Making Headlines podcast. So we appreciate that. You are the mainstay. But yeah, another huge week of news. And I feel like whenever we get towards the pointy end of the financial year, it comes thick and fast. So always keeping us busy, keeping us on our toes. And some of the big major news this week, Charlie, was the story that you broke around record market share for the broker channel, which is super exciting to see. We're finally over the 80% mark for broker market share, which is incredible.
Yeah.
What was the lowdown from the stats? Why do you think people have been increasingly turning to brokers?
Well, like you said, it was an incredible result and a really steep increase on the last quarter's result. So December 2025, that broker market share of new residential home loans sat at 76.8%.
Yeah.
And in the March quarter in 26, it rose to 81%, as you did. So it's well over that 80% threshold now. And yeah, when you actually look at the volumes that were settled as well, that's what really took me by surprise on the numbers. $124.88 billion in new home loans, which is an increase of $25.51 billion on the prior corresponding period in 2025.
Yeah, it's massive.
It's huge. Yeah, it really is huge. When I was filming my 2-camera, I had to stop and think.
Double check. Be like, is that right? Yeah.
And it's 3 months of packing all of those loans into a 3-month period. I know that was at the start of the year when you know those rate hikes hadn't all kind of.
We just had the February rate hike.
Exactly, but they those 3 consecutive rate hikes hadn't filtered in yet. We hadn't had the tax changes yet, so there's obviously a little bit of delay in these numbers. But like you said, a massive result.
A massive result. And like so many people, like finally over the 80% mark, because we've been talking about it for a long time, being like, where will we get to?
Yeah.
Will we ever get there? And I think a lot of CEOs, particularly, this data came from the MFAA, I think we should say as well. And I know that Annie Kane, CEO, has for a long time been saying we should get to 80% easily. So I think finally we've got there.
Yep.
I think she's probably like, hooray, our job has been done now. We can kind of take a breather because we've been talking about this for a few years.
Yeah.
But incredible to see. And I think the volume of loans that are being written by the broker channel is obviously eye-watering as house prices continue to escalate. So this is obviously for the March quarter. We always have a slight delay when it comes to data for broker market share. But for the March quarter, and as you say, we only had 1 rate hike in the middle of that quarter in February. So there was still a little bit of that a summer period kind of lag. So over January, brokers were still working quite hard. I think this year just gone because there was lots of conjecture that rates would start rising in 2026. So loads of people, I think, kind of pushed forward their getting into market. And then, of course, we had things like in October, the expansion of the home guarantee.
Yeah.
The first time buyer guarantee. What is it called?
5% deposit
Thank
scheme.
you.
Yeah.
I cannot keep track. I'm like, keep on changing the names of it.
More commonly known as,
So I think there's been a lot of impetus for people getting into markets. So it's great to see so many brokers taking a big pie.
And now we're one of
piece of the pie.
3 countries with over 80% mortgage lending. UK and Netherlands.
Yeah.
So Australia joins a pretty lucrative club. But like as you were saying, I guess the lending environment is just becoming more complicated for borrowers out there who are increasingly turning to third-party guidance.
So
it's no surprise that this number is has shot up, especially with these tax changes as well. I don't know. I suspect that this will remain at this level, if not increase. I don't think it'll dip, because you're going to have borrowers out there, investors out there that are going to want, I guess, professional assistance. There's uncertainty is rife, and they're struggling to wrap their head around all of these complicated, complex changes and shifts. Who better to turn to, I guess, than a broker?
Yeah, it is interesting as well to sort of it's hard because we don't necessarily see the consumer's sort of perspective from where we are sort of reporting on the industry, but it just goes to show 8 out of 10 that shows the proposition is really resonating with people.
And I think last year we do have some data around consumer sentiment towards brokers. So Agile Market Intelligence, which is the research arm of Momentum, does a report in partnership with the Finance Brokers Association of Australia, FAA, called the Consumer Access to Mortgages Report. And the one from last year, the 2025 Consumer Access to Mortgages Report, which surveyed consumers being like, would you use a broker? Have you used a broker? And if so, why? Majority of the time, the reason why they're turning to brokers is because of the convenience factor. So being like, I don't want to do the admin, and also I want to talk to a specialist, basically. And I think, as you said there, Charlie, increasingly people will be like, I actually need a specialist because I bought an investment property or I want to buy an investment property and I don't understand what's happening with CGT or negative gearing changes, or I don't know if I qualify for these schemes because they keep changing and I can't remember what they're called. Or, it might be... a lot of names. Yeah, a lot of names. Or, it might be that they increasingly are just like, servicing's too tight and I don't know where to go. Can I even access a scheme? How do I structure my savings, and can I kind of budget a little bit better? And brokers doing a lot of financial literacy education as well with consumers. So I don't know about how much further we can go from here.
Oh, well, yeah. Well, I mean, I guess there's always going to be debate about, have we reached the peak? Have we reached the ceiling? Is it, is this the maximum that brokers can expand in terms of share? But I also find it interesting when we nut down into the major bank results and also results from other lenders, and you see kind of proprietary lending slowly on the rise. You still got third-party share climbing and the broker share increasing on these surveys.
Yeah.
So
and
it's interesting to see.
This is something as well, like, when we do talk about what the major banks are doing and report on their financials, they're talking about what they're doing right now. So it hasn't yet filtered through. So I do think this is why I'm not sure how much further it can go, because so many of them are investing in AI and technology now where there will be a lot more proactive AI agents talking to borrowers at the banks to be like, hey, you might want to refinance or reprice, which they aren't yet currently doing en masse. We did see a report from Westpac actually yesterday morning come out, which was talking about all the tech and AI that they're embedding into their platforms.
Yeah.
CBA has spent a huge amount of money on AI as well.
Spellbinding.
So I think seeing all of this technology come through the banking platform, will actually start eating into broker market share.
I guess it's a question of what consumers want as well. I guess do they want to sort of have access to someone like a broker just to sort of feel like you've done due diligence?
Oh, 100%. Yeah, they'll definitely still be majority, I think.
Quality.
I just don't know if it can continue rising. I don't know if it will remain over 80% for too long.
It's what people remember too. Like, I think it's the age-old thing of customer service being key, and if you had a positive experience, then you're going to recommend it to others. It'll stay with you. You'll go back. You'll return. Yeah. So if you have a positive experience with a broker as opposed to a banker, then logically these numbers will kind of hold more or less where they are.
And the questions that brokers ask as well, I mean, I think the problems that a lot of the AI and the tech platforms have with the banks is that they're just doing it for a point in time. So being like, right now you might be able to refinance or reprice to this. Do you want to do it? And if you can just easily go, yes, please, and they do it, you might then find actually go, you know what, actually I forgot that I was planning to have a child next year, or I have just started this business and actually that massively impacts what I can do now. So I think like having a broker to really walk you through what does your life look like, what do you plan to do, not just this year, but in the next 5 to 10 years will determine what kind of loan you go through as well. So
it's a really good point.
Yeah, the advice is so important. But talking about, all the sort of changes in the market and what we've been seeing from the banks, we did have some big news from a major bank this week that had some eyebrows being raised, particularly mine. Both of my eyebrows raised. And I was like, what?
Likewise.
Because NAB changed its rate forecast to say the next movement will not be up, but down.
But down. Yeah, so huge news coming through in the middle of the week from National Australia Bank. So they were one of 2 major banks still anticipating a hike. NAB had changed its forecast and lowered it to 1 in August, and Westpac is still that outlier, predicting 2, but let's see if they hold on that. But yeah, NAB has revised its official rate forecast completely, and it now thinks that the RBA is going to adopt an extended hold moving forward, and that the next move will not be a hike, as you said. It'll be a hold, and they've brought that. It'll be a cut.
Yeah.
It'll be a cut. A hold is not a move. It'll be a cut, and they've brought that cut forecast forward as well from H2 27 to Q2 2027.
Yeah, so instead of the second half of next year, the second quarter.
Second quarter.
Yeah.
And they've attributed this to a number of things. They've basically said that they've misread. The bank thinks that they've misread the consumer. Misread ongoing seasonality issues clouding the assessment. Consumption outcomes may be better than we anticipated in coming quarters. So they think that this shock from the Middle East conflict and the impacts of it aren't going to be as substantial as they previously thought.
It's so difficult, the Middle Eastern conflict. I mean, I feel like
that's the thing. Now, look, it's sparked back up again.
But the US equities market is still doing super well. It's so confusing. Ben, when you kind of look at what the rate forecasts are now with the banks, so we've got Westpac saying 2 hikes this year. We've got CBA saying prolonged hold. We've got NAB saying prolonged hold and then a cut. And then we've got ANZ saying...
Well, a prolonged hold as well.
Prolonged hold too.
Yeah.
All right. Whose camp do you sit in, Ben? Who do you think will be coming up right on the money?
Hard to say, really. I sort of tend to side with the prolonged hold side of things based on sort of ongoing uncertainty, and I guess the RBA will probably want to see how these Middle Eastern tensions sort of play out. But yeah, I don't know. I think the NAB one was a really surprising one. It sort of came out of nowhere this week. So,
It's worth mentioning that CBA and ANZ are also penciling in cuts in 27 as well, in the earlier part of 27. So they've all got a pretty similar view on when those cuts are going to come in. So realistically, we're not going to have this 4.35, well, according to the banks, this 4.35% official cash rate for very long. If anything, it'll be with us for another year maximum, according to these three. So it's not as bad as they were saying 3 months ago.
Yeah.
Nowhere near as bad when they were all expecting the cash rate to peak far above where it is now, potentially 50 basis points above where it is now. So I think it's obviously welcome news for many, many borrowers out there who, when that conflict began, you just had this barrage of, well, inflation will shoot past 5% mid-year. Those forecasts have now been, inflation forecasts have now been reined in by all of the major banks. Treasury out there saying as well that, well, yeah, we're also anticipating it to go beyond 5%. So, potentially the impacts of the oil shock aren't going to be as significant as they initially thought. But still, I think the RBA is going to be very cautious moving forward, because anything can happen at any given moment. Like, you never know what could happen.
It is tough to read too, because the markets have been reacting in strange ways to the oil shocks and all this sort of stuff that's been going on. So
yeah, you kind of feel like it will happen once and you go, oh, okay, well, when conflict breaks out, then everything kind of gets messed up for a bit and inflation skyrockets. But this time round, we've had more conflict and not much reaction. It's really weird. So I think now everyone's just like, oh, you know what? We'll just focus on doing what we're doing and kind of ignore the noise and deal with it when it comes onto our doorstep. It's a really odd economic environment. But I think this is, again, the thing that we've been talking a lot about, is that people are still spending, even though concerns are really high about the economy. So people are still spending money. There's still not a massive amount of hardship, but people are worried about a recession. I saw a Finder survey this week that said something like 60% of people, was it 60? No, it was about half. I think half of people think that there will be a recession this year. And I think maybe go back a month, that might have been the case. I feel like now, though, people are feeling a bit more buoyant.
It's a dichotomy, because spending's holding firm, but sentiment's in the bin.
It's always the way.
Yeah.
People think people are pessimists.
Yeah, and expectations are a funny one as well. You had a retiring member of the Monetary Policy Board give a speech early last week, and he basically said, look, this is extraordinary, but I'm allowed to give this speech, but in newsflash, I'm retiring. My last board meeting is in August. And he kind of said the opposite thing. He said, well, look, the inflation outlook is really concerning, and where alarmed by inflation expectations among the populace. They're de-anchored. They're not where we want them. Yeah. So you never know.
And then it's the opposite of business. I mean, like business conditions have been abysmal, but confidence pretty high.
Yeah, we had that
Strange
business survey a couple of days ago from NAB, which showed that it was, not as bad as the bank expected.
Yeah. So an odd time to be an economist anyway, constantly having to rewrite what your forecasts are and re-gauging what people are feeling and doing because they're two different things.
Yeah.
But as we talk about the banks, we've got some more data coming out from them, which is pretty interesting about future trajectory of the mortgage market. And we'll get into that just after this break. So Charlie, you wrote a story for Friday morning, this morning, which was about ANZ's and Westpac actually talking about what's happening in the lending market. And this kind of follows on from a few other comments we've seen from different major banks recently about what will the rest of what will FY27 basically look like for lending. And ANZ suggesting mortgage lending coming right down.
Yep. So these were comments delivered by Nuno Matos, the chief executive of ANZ, on Wednesday at the Morgan Stanley Australia conference. He, in no uncertain terms, basically said we expect the mortgage demand and inquiries to slow, and we're flagging a slowdown on that front. His quote, and he attributed this to the proposed tax changes introduced by the government in the budget to CGT and negative gearing. He said, quote, "We have no doubt the mortgage market will slow down. It has been growing at around 8 to 9% before. It'll probably grow at 5 to 6%. And he was referring to the short to medium term. From a price perspective, this is obviously in regard to house prices. He kind of left that ambiguous, but he said it could be between 5 to 20%. And they've revised house prices down.
Down,
yes.
Right. I was
what? Not up. Flashing news. And he kind of said, well, we've got a range of forecasts on that. He said, look, we think the changes will do what the government expects them to do, which is to make house prices for first home buyers more affordable. and put more properties onto the market and make properties a lot more accessible. And you're kind of seeing that happen now inadvertently with people shifting to the vibe.
I think this is also like the big thing is that people the headlines you read of being like, property prices will plummet. And it's like, no, they're still going to go up like 5%. They're
annually,
just not going up 10% a year.
Exactly.
Like this is just slowing it down, which to be honest, for most people, apart from people wanting to sell their house immediately, for most people, that's a good thing. Like trying to cool the rampant growth of house prices
and
is a good thing because it's so crazy here. But yeah, so I thought it was interesting seeing ANZ talking about the fact they think that mortgage lending will slow down.
Me too.
Mostly because, of course, what does that mean for brokers? You know, if their business is going to be slowing down, if they're not going to be doing this boom, like, 25 million in the March quarter?
124 billion. Yeah,
sorry, billion, not million.
Billion. Yeah.
100 mil, one broker could do. 125 billion in a quarter. Then I think that we will start seeing that cool down. And that, of course, means for brokers, well, how am I, making sure that I'm still covering my costs, that if I've brought on new staff, that I'm still able to pay that staff, those staff, that I'm kind of prepared for a potential cool down.
So as you mentioned, we also got some new data from Westpac as well, which echoed similar sentiments, and these were new mortgage applications, average mortgage application volume. So for the third quarter of 2026, they dropped to 30,000 from 33,000 in the previous quarter. But interestingly, they also included volumes after the federal budget was handed down. So between 3Q 26 and the budget, it's dropped again.
So sorry, that's the end of March quarter to May.
Exactly. So in those couple of months, new average mortgage application volumes have dropped to 27,000 from 30,000. That's
so it went 33 to 30, 30 to 27.
Yeah. And their forecasts are also, like ANZ, pointing to slower growth, interestingly, across investor and occupier portfolios. So total housing credit growth they expect it to ease from 6.5% in 2026 to 4.7% in FY27. But specifically for the investor cohort, they're predicting that to drop from 8.4% in FY26 to 4.4% in FY27. So that's half.
It's a pretty big jump. Are they saying that specifically, though, about the budget changes? Because we should also say that's not the only thing influencing demand.
No,
of course, we've got the rate hikes in there too.
That's just their amending their forecasts. And previously, I reported on Westpac going into detail about how they think these proposed budget changes are going to impact everything, including investor demand, including the new home category, including supply. It was really comprehensive. And in that, quote, combined with recent and expected interest rate increases and the changes, we expect to see a 34% fall in new investor activity in the near term.
Wow.
With the mix skewing towards new built dwellings.
Of course, yeah.
Yeah, so I think there's going to be hot.
If you can find
category.
someone to build one.
Yes.
But yeah, I mean, that is
Good point.
interesting because, of course, if the volume of mortgages was dropping, we're always looking at, well, who exactly is in market and who isn't. And yeah, so interesting to see. What do they say? A third drop in investor?
34% fall in new investor activity
Over a third.
in the near term.
Yeah, which is pretty chunkable size.
It's a
So
lot.
yeah.
Yeah.
Well, very interesting. And the other thing we've been talking about has been, well, what do these changes mean for property prices, as you've referenced there already, but also for people who have recently bought. And I think some of the conversation and concerns that we've been seeing from people are saying, well, maybe all these first-home buyers who came into market after the 5% deposit scheme expanded might be facing going into negative equity. We've been talking about this internally amongst ourselves quite a bit. And the conversation we've been having, has been saying, well, will that really matter? Because if they've only just moved in, they're surely not going to sell anytime soon.
No. They've got 30-year loans.
30-year term, yeah. They've got plenty of time for that to come back round again. It might go up. Their property might go up 5% this year, according to the least, exciting house price forecast at the moment.
Yeah.
So we're still seeing growth, but just slower growth. I think the concern is what happens if you're in negative equity. And of course, that is more of a problem if you're on the Help to Buy scheme than it is on the 5% deposit scheme.
Yeah.
But some people saying, nah, it doesn't really make a difference. CBA and RBA both talked about this week. What were they saying?
So CBA crunched the numbers on this negative equity risk, and they specifically looked at a group of first home buyers who used these smaller deposit schemes to enter the market at the beginning of this year. Mm-hmm. They forecasted to the end of this year, what would that do to the price value compared to the loan? Yeah. On their revised outlook, Sydney dwelling prices, which are expected to drop by around 6% by the end of the year, Melbourne's are forecast to drop by 7%. So Sydney looked at a first home buyer who bought a $1.5 million dwelling, which is the max under that cap.
Sorry, are you saying they're saying house prices will drop 7% in Melbourne?
By end year, yes.
Drop 7%?
Yeah, while Melbourne is forecast to fall 7% over the same period, so year on year, from 25 to 26. Mm-hmm. So it's not that major. And Melbourne's been decreasing for a while now anyway. But yeah, to show what that kind of translated to at a household level, it looked at a first home buyer who bought a dwelling at 1.5 mil with a 5% deposit, and it projected that buy would finish 26 with only $2,377 in equity, while in Melbourne, it looked at a property that was purchased for $950,000. After a year of repayments and a 7% price fall, the borrower would be almost $8,000 in negative equity, with the loan obviously exceeding the property value.
Yeah, but as I say,
it's
they'll make it up the next year.
Temporary, yeah, hopefully, and hopefully prices will kind of climatize, recover.
This is actually a thing as well. So when I got my mortgage in 2022, I was tracking the value of my house, and I actually had to end up turning it off because I was getting so fixated on it. And I was like, I don't know why I'm bothering checking what my house price is doing each month, because I'm not planning to sell it anytime soon. I'm not planning to renovate anytime soon. I don't need to know.
A bit counterproductive.
But it's just causing stress because you're like, oh no, like the equity's gone down, or like, oh no, I've dropped by like, I don't know, however much this month or the last 2 months. And I was like, it was actually quite stressful. I was like, I'd just rather not know until I actually need to know.
Ignorance is bliss.
Exactly. Ignorance is bliss.
But yeah, that kind of follows a similar line to what the RBA was saying last week when it was in front of the Senate Estimates Committee. Michelle Bullock sort of appeared before the committee, and she's had a line of questions from Senator Andrew Bragg about the 5% deposit scheme and the prospect of negative equity. The first sort of question Senator Bragg asked Bullock was whether they've seen, whether they were sort of worried about the prospect of borrowers who've used that scheme falling into negative equity if house prices decline substantially. And she said, they're basically not overly concerned at the moment. It's practically no one is in negative equity at the moment. She didn't dismiss it as a unvalid concern. She sort of said negative equity does matter if people sort of get into trouble with their loans and that kind of thing. But she sort of reiterated the fact that borrowers in negative equity at the moment currently reflect a small segment of the market. Yeah. And she also said that's why a strong employment market is really important too, to make sure as many people are earning as they can. So,
wage growth is still keeping up. The thing actually I was thinking about down in Melbourne and property prices going down 7% is interesting because we obviously were talking about, what house prices are going to be doing this year, but that's averaged across all states. And I remember reading something about WA. I think in the last year, the median house price in WA has gone up 25%.
Yeah. This national story of house prices dropping in Melbourne, Sydney, ACT, and kind of Tasmania as well, has overshadowed what we were writing about in February and March.
WA and Queensland.
Exactly. Perth, Brisbane, Adelaide were exploding, and they're still running quite hot. Like, growth forecasts have been downgraded, but not by that much. Certainly not in Perth. They're going gangbusters.
Yeah. Snap.
Yeah.
And I think that is the thing, like seeing so much of the kind of, we always have one of the city capitals of the states normally would be leading the way. And for so long it had been Sydney and Melbourne, but obviously now they're too expensive. They're really cooling down, and Melbourne has had an oversupply of an apartment issue as well, coupled with, the whole cladding issue too. So we've seen different sort of speed economies, but WA, Queensland still going absolutely gangbusters. It has 25% increase in house prices in a year.
And then you look at individual suburbs. You get those totality reports and you look at some of those regional suburbs and they've grown by 135% year on year. It's
Bunbury is completely gone mad.
Defying the national narrative there for sure.
Which makes it, again, the affordability issue a big conversation to have. If you live in Bunbury, for example, in WA, and they've had an airport recently, they've had a huge amount of investment activity there. They've had a lot of generation of money coming into the area. Suddenly people are like, well, I've been living here my whole life and now I can no longer afford it.
Yeah. Priced out of your own
priced
suburb.
out. So affordability, a constant conversation we're having. But I just thought the negative gearing chat and the negative equity chat this week, just all the negative chat basically, has been quite interesting to follow, to see what is happening, what do banks think is going to happen to house prices, and what investor activity is going to be doing.
I think it just quickly in that CBA story on negative equity, there's also a lot of information from them as well on downgrading their forecasts and applications on investor and owner-occupier loans. So just to our listeners and viewers out there, go and check that out as well, because all the banks are talking about it.
Yeah. And of course, CGT negative gearing is still not law, because we've had the legislation pass the lower house, but they're still going through the very, very rapid inquiries and consultations.
Yeah, ramming it through.
Hopefully before, I think they're intending to get it through before July. So we've got next week, we've got a couple of hearings being held for is it Senate that are looking
Senate.
at? Yeah. And we did also get a report from the Greens, who were sort of heading up the Senate inquiry a few months back, and they've been reiterating some of the findings of that to be like, remember, we don't think this is a great idea. So we'll be covering obviously the hearings next week as they come through and seeing what people are doing and how they're responding to it. Of course, this is now split into two lots of legislation. So the current set that are going through Parliament don't really have much of the detail for business CGT changes. This is
what was
mostly
announced
focused
in the budget.
Yeah, this is focused on the housing, the investment property housing, and also includes the tax cut, which I think government are hoping will ease its passage through the parliamentary process.
Yeah.
But we do also have a second lot coming through, which currently, apparently, the government are consulting with different business groups. And we've heard from the different associations like the MFAA and COSBOA suggesting that brokers actually have a look at the business CGT changes and maybe write to their parliamentarian, their MP, to be like, hey, I don't think it's a good idea. Which I thought was pretty interesting.
Well, on that, I have written a story today kind of about that schedule, that this bill, uphill battle that it faces to pass before the winter recesses, as you were talking about, and then it's obviously set to face that two-day Senate inquiry that the coalition is pretty peeved about, and the Greens as well. But
everyone
apart from the government, but also the final day of Treasury consultations was held earlier in the week on 9 June, and these were the big business peak bodies that were given the opportunity.
Well, everyone could respond.
But still, the government kind of Anthony Albanese indicating that, well, he rattled off obviously the Chamber of Commerce and the Small Business Council of Australia, and they've published their submissions, and I've written about that, and some interesting calls from them as well, obviously blasting the entire proposal. The Australian Chamber of Commerce said that it would have a sustained significant impact on business investment and productivity, and it ran counter to the government's stated priority to lift productivity. They said that extending the CGT chain to all of the asset classes as opposed to housing would be counterintuitive. And they said, quote, showed a clear lack of understanding of the consequences for business investment. So they called for the CGT to be removed from all asset classes apart from housing. And the group has also said that the current $2 million turnover threshold beneath which businesses can access certain concessions should be lifted to $10 million. And the Business Council of Australia, funny enough, has also said that after this policy has been in place for a couple of years, 2 or 3 years, we need to hold a, quote, mandatory, fully independent, transparent review within 3 years to assess the effectiveness and efficiency of any changes in meeting their own objectives. Because obviously you had Paul Keating, who removed this back when he was treasurer under Bob Hawke, and then he re-implemented it 2 years later.
Yeah.
So I think the government doesn't want that to happen.
Well, I think this is again why there's a lot of groundswell, particularly when it comes to business investment. So I think with the MFAA sort of talking about small businesses saying, well, the proposed CGT and trust taxation changes will actually really impact mortgage brokers and finance brokers, because this is how they've kind of, planned for the future. This is a lot of their succession planning, kind of, they've been looking at the tax treatment of what their business has been doing, particularly as, mortgage brokers get to retirement age, which the first wave of brokers have started retiring. It's about a 30-year-old industry now. So this is a big deal for a lot of people. And they're really suggesting that, members kind of write to their local member of parliament to sort of call on them and showcase what it would do to their business. I think the MFAA has also released its own submission to, the Senate Economics Committee as well, saying basically, brokers, the eventual sale of a broker business is a central part of a retirement plan, and changing the way that you're taxing this and will actually impact the real value that they get at the end of their careers. So it's a big problem.
Which is what a lot of entrepreneurs and business owners are concerned about, are that tax that they face after they sell, and the kind of marginal tax rate that's applied to them, and that's causing a lot of uproar here, inadvertently, or maybe not. Who knows? I don't know. The government foresee this? Did they not, extending it to all asset classes, including the sale of a business? Anyhow,
yeah. I mean, we've certainly heard a lot about it in the last couple of weeks, but it'd be interesting to see where the government lands on everything, because it does impact small business owners, but it doesn't impact everyone. It doesn't impact employees and that kind of thing.
Well, it does if they get shares.
If they get shares.
Because then if they want to sell those shares, if they
sell
want
those
to
shares.
sell those shares, then they'll have the higher tax rate.
Yeah.
Because they don't get the 50% discount anymore. So that will be potential impact. So again, I think this has also been an argument for a lot of the small business owners in in Australia as being like, well, we can't afford to give people super high salaries. So part of the things that we do is give them, equity in the business or shares in the business.
Yeah.
And then if now that tax treatment has changed, that's not going to be as valuable as it used to be, and therefore not be as attractive as it used to be, and therefore impacts how we can hire and people.
But they could also pay those people more as well, I guess.
The government's saying
the question.
Can they?
Counter to that, the government's saying that's why they've kept in place franking credits too. They're kind of, well, don't forget about that. You still got that. But yeah, anyway, I think the government's wishing they had 4-year terms instead of 3-year terms at the moment. But anyway.
I wish it's 2. It's annoying it's a 3-year term. I think it's ridiculous. Anyway, we've got more to unpack after the break, including some big appointments, and we'll get into that just after this. So again, end of financial year, turn of financial year, another opportunity for people to hire and change job, think about their new careers. We always see towards the end of calendar year and towards the turn of the financial year, these are the 2 main periods where people sort of tend to switch jobs. And again, we've already started seeing some big appointment changes. We had a CEO appointment this week, Charlie, that you wrote about.
So Helia, one of Australia's largest specialist lenders, mortgage insurance providers, has named insurance veteran Mark Senkovics as its new CEO and MD. The board announced the decision on Wednesday, and that Senkovics would formally take charge on or before 1 December 2026 after what it described as a, quote, extensive executive search. He spent 2 decades in the insurance sector. He was at Steadfast Group, which is Australasia's largest general insurance broker network. And he was, prior to that, he was also spent 20 years at global reinsurer Swiss Re and a number of senior positions, including managing director and head of property, head of Australia and New Zealand, and head of the Korea branch.
Oh, cool.
Yeah. So I guess interesting times for them as well. They're kind of battling a kind of number of challenges.
Yeah.
They've lost their long-time contract with CBA in March 25, and they've gone to another provider. And ING Bank, which is the nation's 6th largest lender, is also negotiating with another provider.
That's a little plug for ING there.
And at that time, just after this ING negotiation was directly after CBA announced that it would not renew its contract with Helia. They launched a comprehensive business review aimed at reshaping strategy. And you've also got the 5% deposit scheme.
That's the big one.
And schemes like it in the background that are, disrupting LMI and demand for LMI and are capturing a larger piece of the pie there. And demand for that is insane. So it kind of explains why their premiums are down and that kind of thing. But
if you think about the amount of people that have actually already gone through the deposit schemes, I think a couple of months ago it was around 200,000 people. If you think that's 200,000 people that no longer need or want or have taken LMI, that's a massive chunk to your bottom
massive.
line. And that's just the federal one. We haven't even talked about the state-based ones. So they have their own state-based ones.
Heaps of them.
We haven't talked about, the amount of people that are kind of using things like guarantees. So there's a lot more innovation, I think, now in how we can get people onto the property market. And that has really impacted Helia. And of course, as you mentioned there, losing 2 of their biggest clients. Obviously, they needed a review.
Yeah.
So a new CEO coming in is going to be tasked with a hard job of fighting some of these challenges to their business model. But we've got a while before he comes in. So December, did you say?
Yeah, they said anytime before 1 December 2026. So
some point.
He could be sooner rather than later. Who knows?
Okay. Is he moving from another country? Is that why there's a
I'm not too
question
sure
about when he starts?
I'm not too sure where he's based geographically for his current role, but he's CEO of underwriting agencies at Steadfast Group. I think he's Sydney based, so I'm pretty sure he is Sydney based.
Maybe his notice period is still being worked out.
Yes.
The other big appointment we had this week, which I thought was really interesting, was seeing Dino Pacella come back to the broker space. So he, as you probably well know, is the founder of National Finance Brokers Day, which is a national day that he created a few years back to celebrate and champion the broker channel. He currently has been working at the commercial brokerage Simplicity and Marketplace Finance. And before that had a lot of experience working for the lenders. So he'd people might remember him as the BDM for Suncorp Bank back in the day. But now he's joined Aussie Home Loans, which is part of Lendy Group, obviously, to become its first general manager of retail. So really tasked with scaling the franchise footprint of Aussie Home Loans and kind of taking it to the next level, which is exciting to see. So they've created this job to really focus specifically on Aussie branded franchises and lifting store performance. They've been putting a lot of effort and work into what their stores are doing now. Back in the day, I think Aussie brokers would probably go to people's houses, and now an Aussie storefront is part and parcel of the high street. But also you can go into an Aussie store now and talk to a conveyancer or real estate agent or buyer's agent. So they have always kind of add-ons where they're kind of making it a much bigger proposition if you do go. So I think he's going to step in from the new financial year, 1st of July. And that's exciting. He's got obviously heaps of financial services experience. Brokers will probably know him already. If they haven't, they will. But I think that's really interesting to see a new role for the Aussie Home Loans Lendy Group.
It is a new
coming
role,
about. Newly
created.
Yeah. So some appointments. I'm sure we'll hear some more. Last week, you guys were talking about. You guys were talking about.
Me. I was not present.
I looked at you and was like, no. Then you were talking to Julian about the new CEO and chairman of the FBAA, the Finance Brokers Association, which is obviously a major news story. So as we said, this time of year, people announcing who's going to be taking up the helm in the new financial year.
Yeah. New financial year, new me.
New year, new financial year, new me. And speaking of new stuff, we concluded the New Broker Academy today in Sydney, which has been a wonderful roadshow. We went to Brisbane, Melbourne and Sydney today for it. And it was so wonderful to meet so many new brokers. I think in Melbourne, we had over 150 new brokers who were already in the business, and then probably another 50 who were thinking about becoming a broker.
Nice.
And it was so much fun meeting people who've been listening to this podcast, who've been reading our news, who've been thinking about becoming a broker. And we're so thankful to all of our speakers as well, including some elite brokers who've been really lifting the lid on what it takes to build a successful brokerage brand, including Blank Financial and Innovate. So it was Bernard Desmond from Blank Financial and Nick Riley from Innovate talking about the blueprints they follow to get their brokerages up to the top level. Nick Riley's session, he was talking about how he gets his brokers to 100 mil, and so many brokers were like literally furious note-taking. You could see the pages turning as they were writing their notes down and taking pictures of his session because they all want to get to that kind of elite broker status. So yeah, fascinating content, so many good time, good vibes, good chats going on as well. So it was wonderful to meet so many new brokers. Actually, a couple of people who I met at New Broker Academy will be on the podcast, the New Broker podcast, fairly soon.
Nice.
Because I got to have a good chinwag with them and be like, you know what, we should amplify this story because it's exciting. So stay tuned for that. But yeah, wonderful to meet so many people, and thank you to Bendigo Bank Broker for their sponsorship of it and for helping us continue to make the New Broker Academy a free event, which I'm sure many new brokers appreciate.
Yep.
And speaking of events and becoming elite brokers, this week just gone, we opened the submissions for the Australian Broking Awards, which is our national awards ceremony, which takes place in August. And yeah, if you think you've got what it takes to be named a champion of broking in 2026, then do make sure you submit for an Australian Broking Award, which is run in partnership with principal partner NAB. We had the Better Business state-based awards earlier this year, so this is really an opportunity for all the finalists and winners to compete for a national award. So you've got WA winners up against Tassie winners. You've got the New South Wales people fighting with the Melbourne people. It's very exciting to see everyone come together in one big room. It's a daytime event as well, which is a lot of fun because you kind of can get all of your awards out of the way. It's on a Friday, and then start your weekend early.
Kick on. Yeah,
definitely.
Depending on the result.
If
not, you're there anyway, so you may as well.
You know what? You've paid for a ticket. You might as well just continue drinking.
Yeah.
And of course, we'll have an after party as well for those who do want to kick on.
Oh yeah, nice.
Which has been partnered by Capital Bridging Finance. So we're really looking forward to the ABAs taking place in August. So if you haven't yet started your submission or haven't yet seen that, then do head over to the ABA portal. You can visit it at australianbrokingawards.com.au and get your submission started. Or if you think that somebody else deserves recognition that you work with or that you know, nominate them. Just put in their name. You don't need to fill out the whole submission
Nominate
for
them
them.
And don't tell them.
Well, they get notified.
Oh, do they?
So you can't actually put in, obviously we need a lot of the their financials to give them an award
Bit
or
hard
to
to do
consider
that
them.
then.
Yeah, but you can nominate someone and then our team will contact them to go and fill in the submission. But it's so lovely seeing the amount of people that actually do nominate.
It's really good.
Particularly for some of the smaller awards like, loan admin, where, brokers will absolutely wax on lyrical about how amazing their loan admin support is and then nominate them. And it's so lovely to see those categories and those submissions come in, and our team who help with the entries coming through. I think that's one of their favorite categories whenever they call people up to be like, you've been nominated for loan admin of the year. They're just so touched that their broker has done it for them.
Finally, recognition.
Yeah, and we're like, I thought he was a bit of a nuisance actually, but now I'm coming around. So I think like if you do know anyone that you think deserves an award, these are broking industry only awards. There's no lender awards in this one, so it's broking and aggregation. But yeah, encourage you to get a submission through. ABA's 2026 are going to be a phenomenal day. I can't wait for it already. It's only a couple of months away as well, so quick. You've got to be quick.
Comes around quickly.
How is it almost August?
I know.
That is insane.
Yeah.
We're in June, so we're almost there.
Yeah, we're almost
No, I'm
there.
so
It's
shocked.
practically there. But yeah, you still have some time, so don't get too worried. You still have a few more weeks left. But
It'll creep up on you though.
It will. So do it soon. Charlie, Ben, any nice weekend plans?
I'll probably be watching some of the World Cup.
Yes, it starts on Sunday. Well, Australia starts on Sunday.
Australia on Sunday. And
Yes.
Yeah,
Who are playing Turkey?
Turkey, I think.
Turkey,
yeah.
I
yeah,
think, in the
Turkey.
first
Yeah.
game. Yeah.
And then is it America, Paraguay?
I'm not sure.
Yeah.
I'm not a football guy.
I never used to be, but I am married to a football nut. And actually, so much so, when we got married, it was World Cup, and we had to stop in between the ceremony and the party kicking off so we could watch some of the football.
Wow, dedicated, hey?
And it's actually our wedding anniversary coming up this weekend. So in
nice.
true style, we'll be celebrating by watching the World Cup. This time, though, not at a wedding ceremony.
Yes, yeah.
But yes, we'll be watching quite a lot of that. We should probably do a sweepstake, actually. Haven't done that.
Yeah.
Charlie, any weekends plans?
Just seeing some friends. Yeah, I think I've got a couple of incidental gigs as well, doing the singing. So keeping the part-time, what feels like sometimes full-time occupation going strong, which is nice.
Yeah.
So, yeah.
Awesome. Well, thanks for your time, gents, and thank you all for tuning in, and hope you have a lovely weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.